Tax loss harvesting. It's a term that you will probably never have to encounter in your entire life. And if you do, congratulations. You've made it as far as money goals are concerned. There are people right now sitting in offices all across America whose entire job is to figure out what stocks to sell for a loss. This is the concept of tax loss harvesting, and it's one of the most bizarre and counterintuitive topics in finance. For many wealthy Americans, tax loss harvesting is an essential portion of their wealth plan, and without it, they would lose hundreds of thousands of dollars, possibly millions of dollars, per year. To explain, we begin with some basics. We first need to understand the difference between realized and unrealized gains and losses. It's rather simple. Let's say we buy one share of Intel for $100. 30 days later, we look into our portfolio and see Intel stock is now selling for $110. In this moment, we have a gain. In reality, we made $10, but we haven't sold the stock yet, so our gain is, quote, unrealized. It will become realized as soon as we sell that stock and receive the cash. The same concept applies in reverse for losses. Our Intel stock in an alternative scenario could have been worth $90 after 30 days. This will mean that we would have a $10 unrealized loss. By selling the stock at $90, the loss would become realized. Now back to our topic. Also known as tax loss selling, this strategy of selling securities at a loss is usually implemented near the end of a calendar year. With tax loss harvesting, an investment that has an unrealized loss is sold, allowing a credit against any realized gains that occurred in the portfolio. But that still doesn't make any sense. What are the benefits to all this? Well, this is where this strategy gets interesting. Tax loss harvesting is a critical tool for reducing the one thing investors constantly overlook: taxes. Now, taxes as far as trading goes are classified into two different categories: short-term capital gains and long-term capital gains. If you're an investor whose income is over $434,551 per year, you're subject to a tax rate of 20% on any profitable selling you do for securities you've held on to more than 1 year. But if you're selling profitable securities that you held on to less than a year, then your tax rate is a whopping 37%. Let's go through an example and you'll see what I mean. Let's say John has a portfolio of 5 stocks. Stock A has $250,000 in unrealized gains and he's been holding it for 450 days. Stock B has a $130,000 unrealized loss and he's been holding it for 635 days. And stock C has $100,000 in unrealized losses and he's been holding it for 125 days. Now the trading activity. Bob sold stock E for a realized gain of $200,000 after holding it for 380 days. And finally, he sold stock F for a $150,000 gain after holding it for just 150 days. Because of the tax laws in the United States, without tax loss harvesting, the tax liability resulting from this trading activity is as follows: 20% on the $200,000 profit on stock E and 37% on the $150,000 profit from selling stock F. This means a tax bill totaling $95,000. But John has stock B and C in his portfolio that are currently unrealized losses. If he thinks about this correctly, he can sell these two stocks, which are currently big losers, and offset his gains, reducing his tax liability. So John goes ahead and sells stock B for a $130,000 loss and sells stock C for a $100,000 loss. This brings his tax bill down as seen here. His tax bill is now $32,500. The proceeds of the sale can now be reinvested into assets like the old ones after he waits 30 days. This will preserve the value of his portfolio while reducing his tax liabilities significantly. Welcome to America, where complex accounting, tax laws, and financial genius combine to form an entire industry called tax avoidance, legal ways of reducing your taxes only available to the rich. Let me know what you think about tax avoidance in the comments below, and make sure you hit that subscribe button if you're enjoying my videos.